Okay, great. So thank you, colleagues, for listening to my presentation. I'd like to preface the presentation with saying that I have two research interest areas. One is accounting education, where you heard my paper in the previous session. And my second research interest area is taxation. And I teach taxation at the University of Cape Town in South Africa. Now, it's always difficult presenting to colleagues on tax, because invariably you're not going to pitch it at the right level. Many of my colleagues don't know tax at all, and so they would like me to make the concepts more simple. And many other colleagues are tax experts, and so they would prefer me to be a bit more technical. So I'm going to try my best to pitch this at the right level, but apologies if it isn't correct. So my topic is multinational tax avoidance, an application of controlled foreign companies and royalty payments in South African legislation. My name is Carpenter. An outline of the session: I'm going to be covering the background to the study, then we'll move on to the research question. Then we'll look at a bit of literature review in terms of residence and source and tax avoidance. I'll then be going through the methodology that we used, and then looking at the two schemes that the paper looked at, which is controlled foreign companies and royalties. I will then conclude on the study. So in terms of a bit of background to it, multinational tax avoidance is when multinational companies have foreign entities and they try to reduce liabilities by legally shifting profits to lower tax jurisdictions. And I would like to note here that this is a legal shifting of profit because it's tax avoidance. Tax evasion is illegal. Now, developing companies want international investment, but tax authorities are challenged to eliminate the loopholes in their tax legislation without hindering global competitiveness. South Africa has a substantial budget deficit, but it has low fiscal capacity. And we know that tax base erosion, profit shifting, and international tax competition has a greater effect on developing economies, which leads to our research question. Does South African legislation curb tax avoidance schemes, such as controlled foreign companies and royalty payments, in order to minimize the tax liabilities of multinationals? First, we need to look at residence and source. And in South Africa, a person is taxed on a residence basis. And for a company, it is resident if it is incorporated, established, or formed in South Africa, or if its place of effective management is in South Africa. Non-residents are taxed on source basis. So you first need to look to see where that source comes from, i.e. the originating cause. And if there are multiple originating causes, you need to look at the dominant originating cause. In addition to that, there are some specific source rules in Section 9 of our Income Tax Act. And all of this could result in tax in two different jurisdictions. If that does happen, then in South Africa, you have relief from a tax credit, or if you invoke a double tax agreement, if it exists with that other jurisdiction, that other country. From a tax avoidance perspective, looking at these two different schemes, we've got controlled foreign companies, where, as I said previously, multinationals have foreign entities within the group structure. Also, if there are checkbox regulations, such as the US had, which allows US multinationals to disregard foreign entities' taxable income, that income is only taxed when there's a repatriation, normally through dividend income, and that often never materializes. The other scheme, which is often seen with controlled foreign companies, is royalty payments. And this normally occurs with technology companies, where technology companies license intellectual property in return for royalty payments. And in that way, shifts profits and hence tax liabilities to possibly lower tax jurisdictions. An example of this is a double Dutch-Irish sandwich. As you see from the diagram there, we have a US company which transfers the intellectual property to an Irish company, which is Irish Company A. Irish Company A has Bermuda as its place of effective management. That Irish Company A has a 100% held subsidiary, Irish Company B. US tax law sees both Irish companies as one company. And because the US company's parent company is sole owner of these Irish subsidiaries, and it doesn't have limited liability, it meets the checkbox regulation requirements. And then the net income of the Irish companies is not included in the US company's taxable income. On top of that, Irish law deems the Irish company to be a resident of Bermuda, and they pay zero tax. On top of all of this, a company is created in the Netherlands, where the license for the intellectual property now sits. Irish company B pays the Dutch company royalties, and they're taxed at a lower rate than in the US. The Dutch company then pays royalties to Irish company A, who is taxed at 0%. Subsequent to this, the Irish law has now changed, changed in 2015 or 2016, but the structures which were in place are allowed to continue until the end of 2020. So for my tax colleagues, it was grandfathered through 2020. So the methodology that we followed was doctrinal research methodology, where we looked at the South African tax legislation and interpretation notes and applied it to the situation similar to what you just saw on the previous slide. And for the purposes of applying South African legislation to the avoidance methods, we need to make some assumptions here. We've got a hypothetical resident company, A, which seeks to exclude the taxable income of foreign subsidiaries, companies B and C. The operations are located in foreign company C rather than in resident company A. A foreign subsidiary would thus make a royalty payment to another foreign subsidiary to ensure that profits are transferred to a lower tax jurisdiction to avoid a tax liability in South Africa. So if we look at the first scheme, which is controlled foreign companies, we need to first consider source. If the operations are transferred to foreign company C, who then services customers, and those customers are located in South Africa, then it's from an SA source and will be taxed in South Africa. However, they could invoke a double tax agreement if it exists, which would likely result in the taxation in company C's country of residence. And this is likely to happen as economies shift away from brick and mortar to more digital services. On top of that though, South Africa has Section 9D of our Income Tax Act, where they include net income of company C in resident company A's taxable income. Now, with any tax section, there are multiple provisos and exceptions. One exclusion that's potentially available in the circumstance is if company C has an actual non-tax business reason for operating in that foreign lower tax jurisdiction. However, the question is asked, if company A operates via the internet and has a global reach, why would they use company C as a foreign business establishment other than to avoid tax? What you should see here, and that I haven't covered, is that there's no checkbox provision in South African legislation. The second scheme was royalties. And if company C is either a South African resident or has a permanent establishment in the country, they are liable for tax in South Africa. Section 9D has a provision which ensures there isn't double counting. So it's not included in the net income, which gets included in taxable income, and then as well as a deduction in taxable income. Company C is also required to withhold 15% royalty withholdings tax in terms of sections 49 cap A through H in our Income Tax Act. With royalties, we also need to look to intellectual property and section 23I. And section 23I prohibits the deduction of royalties paid to a non-resident for the use of tainted intellectual property. Tainted is when the intellectual property is or was the property of either a taxable person or the end user, or the intellectual property is used within South Africa. As company C is the end user in the situation, which was acquired from company A, the intellectual property is tainted, and therefore the deduction that they're entitled to is limited to half of the expenditure that has been incurred. So, in conclusion, in some circumstances, the South African Income Tax Act limits the effectiveness with which multinational schemes could avoid tax in South Africa. If a multinational company were able to relocate its business from South Africa to a foreign subsidiary and continue servicing its customers without setting up a permanent establishment in the country, then it may be able to reduce its South African tax liability. However, controlled foreign companies' net incomes would need to be included in their parent companies taxable income, as long as the foreign business exclusion doesn't apply. South Africa also has withholdings tax and royalties from an SA source, which would result in a lower rate of tax than the standard company rate. In terms of intellectual property, if that's transferred offshore while continuing to be used in South Africa, the deduction for that royalty is prohibited, either in part or in full. And the prohibition then limits the opportunity to artificially reduce income taxes in South Africa through the payment of this royalty to the non-residents. Although South African income tax legislation contains measures to prevent tax avoidance, especially with respect to these schemes that have been allegedly practiced by multinational companies, the South African tax base remains at risk.
Was the author to that a couple of years ago.
As modern businesses increasingly shift towards e-commerce, the test that we have been using may be inappropriate, especially in terms of protecting South Africa's tax base. Furthermore, this coupled with deliberate attempts to obscure the nature of the schemes may frustrate the South African.
Professor, to stop there, could everyone ensure that their mic is muted, please? Thank you very much.
I can just start from this beginning of the slide again.
Yes, thank you.
Okay, sorry, so. So in terms of the South African tax base, our legislation does contain measures to prevent tax avoidance of the nature allegedly practiced by the multinational companies in the two schemes that we've looked at today. And as modern businesses increasingly shift towards e-commerce and away from brick and mortar businesses, the permanent establishment test, which I've went over during this presentation, may be inappropriate in terms of protecting South Africa's tax base. Also, if there are deliberate attempts or information asymmetry relating to obscuring the true nature of the schemes, this may frustrate the application of South African anti-avoidance provisions. So therefore, initiatives to combat base erosion that gain traction during the exposure of these schemes that I've discussed today, the controlled foreign companies and the royalty payments, most notably the OECD BEPS project, and potentially the consideration of a digital presence test that could meaningfully contribute to the defense of the South African tax base. Thank you. Are there any questions?